What's going on, team? It's Caddy with Money Investing. I hope that you all are having an amazing day. So in this video, we're going to talk about JD.com. I will do a complete stock and company analysis between JD.com, Amazon, and Alibaba. We will look into the fundamentals, so the financials of the company, what their revenue, their net income, different margins, cash versus debt looks like. And then we'll dive into the fundamental analysis for JD stock. I will build a DCF model, which is a discounted cash flow model, to figure out the intrinsic value for JD.com stock. Right now, you guys can see that it's trading at around $58.46, but we're going to take into account the $58 as a cutoff price, and we will compare our intrinsic price with $58 to figure out whether it's undervalued, overvalued, or fairly valued. Then we'll look into the technicals of the company and where do I personally see JD.com stock going in the near future. As always, if you guys enjoyed this video, please make sure to drop a like. It really helps out with the YouTube algorithm and recommends this video to other people who might be interested in watching as well. Also, subscribe and hit that notification bell so you don't miss out on any future videos related to stock market updates, investing, and technical breakdowns. So first, I'm going to talk a little bit about some quick facts. So Amazon, the current market cap for this company is going to be well over $1.34 trillion. It's one of the biggest companies in the world in terms of the market cap. Alibaba sits at just under $600 billion in market cap, and JD sits just under $80 billion. So you guys can see the comparison between JD.com stock versus the two giants in e-commerce right here. So of all the people in the world, about 80% of the population has used e-commerce at some point in their lives, and the average spend has been somewhere between $1,300 to $1,400 per year on e-commerce online sales. So currently there are about 12 to 24 million stores, online stores worldwide, out of which I think only 650,000 of them are able to generate over $1,000 in annual revenue. So you can see, regardless of this number, how competitive e-commerce is, and you can see how these three companies have taken over a majority of the market share, which we will talk about now. So in terms of the countries ranked by retail e-commerce sales in 2018-2019, China is the first right now in terms of the dollar amount, which is going to be right around $2 trillion as of 2019. The United States at just $586 billion. So you can see how there's such a variance, and China represents almost 4 times the retail sales as opposed to the United States. The UK is at just $141 billion, Japan at $115 billion, South Korea at $103 billion, Germany $81 billion, so on and so forth. And this chart right here shows you the total retail sales worldwide versus total e-commerce sales worldwide. So retail sales in general means all the products that were both online and physically sold to the people, but total e-commerce only strictly means online sales. So as of 2020, the number is expected to be at around $26 trillion for the total retail sales, out of which $4.2 trillion is expected to be online alone. When it comes to the forecasted market share, that number is expected to grow as high as $6.5 trillion by the year 2023, with retail sales in general being just under $30 trillion. So you can see how there's such a demand and such a big market share when it comes to e-commerce and the retail sales in general. So now going further into the market share, this right here is going to be a good representation of the top 10 retailers in China alone. And you can see how Alibaba has a clear dominance at just over 58%, controlling the market share, with JD.com at just 16.3%. So if you go further down the list, you can see Amazon China with just under 1% market share in the Chinese e-commerce market. And they recently announced that they were going to shut down their Amazon China operations due to the high levels of competition faced by this company, due to the likes of companies like Alibaba and JD.com that are essentially controlling majority of the market share in that country. Now, Bank of America came out with a report and said they estimate Amazon currently has about 44% of the US e-commerce market share, up from 40% in 2018, and Walmart is a distant second at just 7%. So regardless of how things are going in China, Amazon is still one of the leaders here in the United States and North America in general. So recently we had an event called 618 in China that essentially happens on June 18th, where there was a huge sale in e-commerce, and JD.com said transaction volume totaled 269.2 billion yuans, close to about $38 billion US dollars. And JD.com and Alibaba combined controlled over $137 billion on that day, or few day period when that event took place in China, which was just about a few days ago, of which JD.com controlled close to about $38 billion. Meanwhile, Alibaba said that they controlled over $98 billion in total GMV value, which is going to be the gross merchandise value. So now if you look into the revenue between the three companies, you guys can see that Amazon is clearly the winner here with generating over $280 billion in revenue as of 2019. JD.com coming in second with just over $82 billion and Alibaba coming in third with just over $56 billion. But regardless of these numbers and how well they compare against each other, their revenues in general for all three companies have been growing consistently, and you guys can see as far as 2015 when JD.com was generating just under $28 billion and how they've gone up all the way from $37, $55, $67 billion to now well over $82 billion. And same with Alibaba when they were generating close to $12.2 billion to now well over $56 billion. So now when we talk about the net income margin, now this is something that's really interesting to look at, because even though there is a huge variance between Amazon's and Alibaba's revenue, Alibaba still has Amazon beat in terms of the net income that they're generating. So how much of that revenue trickles down to the bottom line and turns into a net income. So you can see that Alibaba is generating over $13 billion in net income versus Amazon's $11.5 billion in net income. And JD.com generated a substantially low net income in 2019 at close to about $1.75 billion. And this has also been the first year in the last 5 years when they have reported a net income. You guys can go as far as 2015 when they reported a net loss of $1.5 billion, and then the following year $548 million in net loss, and then a $23 million net loss, to in 2018 a net loss of $362 million, and then finally in 2019 close to about $1.75 billion in net income. So now when we talk a little bit about the growth rates, this right here is going to be the revenue growth versus the net income margin. So you can see how Amazon's revenue has been growing at a rate of 27.32% on average. JD.com, on the other hand, generates about 31.62% on average growth revenue, and Alibaba is the highest at 47.11% of average revenue growth year over year. They're also the highest in terms of the net income margin at around 35.75%, which we already went over. And that's kind of been the average for Alibaba. That essentially means for every $1 in revenue that the company generates, over 35 cents trickles down to the bottom line as net income. So that's actually incredibly high as opposed to the 2 cents and 2.5 cents for Amazon and JD.com respectively. But this also goes to show that Alibaba has a little bit of a different business model against Amazon and JD.com, companies which actually have their own warehouses and are selling products and goods to people, as opposed to Alibaba, which is more of a connector or a middleman between the buyers and sellers, and a lot of different sellers can actually use their platform to sell products, which is why they have less overhead costs, less warehousing, and less operating expenses, and they're able to generate such a high net income margin. So now jumping into cash versus debt. Regardless of the company, in this case, they're all very healthy. They have a really healthy financial statement and a balance sheet, with Amazon just over $55 billion in cash on hand as of 2019 and a debt of just over $23.4 billion, which gives the company a cash to debt ratio of about 2.34. That essentially means for every $1 of debt that the company has, they have over $2 in cash, which is actually really good because they can essentially pay off their entire debt obligations. Same with JD.com, they have over $9.2 billion in cash versus a $2.2 billion in debt. Now obviously they have a less cash value as opposed to Amazon or Alibaba, but their cash to debt ratio is the highest at 4.14. Again, that just means that for every $1 in debt that this company has, they have over $4 in cash, which represents a really healthy balance sheet. For Alibaba, the cash to debt ratio is going to be 1.89, which is the lowest amongst the three, with just over $31 billion in cash versus a $16.6 billion in debt. So now we're going to look into the discounted cash flow model for JD.com only, and I went ahead and calculated the future cash flows for JD.com by taking into account their 2019's free cash flow at $3.55 billion. I essentially took the growth rate of over 5%, which I found on Yahoo Finance, and that was the analyst estimate as the growth rate for the next 5 years for JD.com. So we found a cost of equity of 8.35% for JD.com with a beta of 0.98. That essentially means that they're 2% less volatile than the S&P 500 benchmark index. When we talk about the cost of debt, it came at just under 4% with the effective tax rate for the company at just over 13%. Now using the cost of equity and the cost of debt, we calculate a weighted average cost of capital, also known as the WACC or the discount rate, at just 8.25%, which is also going to be the rate at which we discount these future cash flows to present value. So we arrive at a target share price for JD.com at $63.02 based on the current market price, which we took as the cutoff price of $58, essentially means that the company might be undervalued by 8.65%. Now this right here is a sensitivity analysis value table, something that I like to include in all my videos. Essentially goes over, based on all these different WACC values and growth rates, how the stock price or the intrinsic value will change for this stock. Again, I want you guys to understand that this is heavily based on my assumptions, which is going to be a high growth rate of over 7.5% and a more sustainable growth rate of 3%. That essentially means that these future cash flows are growing at a rate of 7.5% until year 5, after which they're going to grow at a rate of 3% indefinitely. So if you change these inputs and assumptions, your results will also change drastically, something that I want you guys to be aware of and take a note of. So now we're going to jump into my TradingView platform and we will look into JD.com stocks pattern, how it's been performing over the years, and where do I personally see the pattern going in the near future. Alright guys, so here we are inside my TradingView platform. This is the platform that I use to look at all my charts, all my patterns, create all these different watch lists, create alerts. So if you want to get started, all the links are going to be down in the description below. So right now we're looking at JD.com. Their ticker symbol is going to be JD and they're listed on the NASDAQ exchange. And going back as far as 2018, when they were trading at just around $19 a share, they have gone up significantly, over 220%, now trading at well over $58 a share. They have those key support resistance levels that we can identify very easily. Back in 2016, when they were again trading at $20, right around that level, they pushed up to $50 a share, essentially giving us a 146% return in a matter of 2 years. And then they pulled back all the way down to $20 a share. So that, in my opinion, is going to be a very clear support for JD.com. The $20 to $21 a share, because that has been validated not once but multiple times. Once in 2014 when the stock was trading right around that level, then pushed up, pulled back, validated that support once again in 2015, pushed up, pulled back again, validated that support again in 2016, pushed up, consolidated right here in July of 2016 before pushing up all the way to $50, and then it made its way back down to that level more recently in 2018 before breaking out of its resistance at around $50 to reach all-time highs at around $60 a share. So a clear resistance is going to be right around here, $50, because again, it has validated that resistance once in 2017 and then more recently again in January of 2018. It has gone rejected here multiple times. So now if you look into the pattern more closely and go into the daily chart, we can kind of identify that it has been trading above its 200-day moving average, which is the blue line, and it has bounced off of those levels multiple times. So in my opinion, based on the technical indicators such as the RSI and the MACD, and also understanding the fact that it has gone up quite a bit since March, well over 71%. Seems like a little bit too overextended and overbought in my opinion. So I'm going to personally wait for it to pull back close to about 12 to 13% if it does drop back to $50 level, which we have recognized as a previous resistance, which moving forward can act as a very good support, because based on technical factors, we understand that old resistance levels have the tendency to become new support levels moving forward. So if it were to pull back down to that level, I would be very interested in looking into this stock. It is a growth stock because it has been growing quite a lot over the years and it has double-digit revenue growth rates. The only thing it needs to focus on is how it can turn a better net income margin and how it can generate a net income on a consistent basis. Because we looked into the revenue and we looked into the net income, the company has not reported a net income for the last 5 years up until last year in 2019. So that's something that I would be looking into very closely, and I will go ahead and create an alert right around the $51 level. And if the stock does break below that level, I would be personally watching it very closely and would be very interested in investing in it. Again, like I said, it seems like a growth stock to me. So I hope you guys enjoyed this video and my complete breakdown of JD.com, and we looked into their revenue, we looked into their net income, we looked into the financials, cash versus debt. Then we performed and built a DCF model, which is a discounted cash flow model, and my personal target share price came at just over $60. But again, there's a lot of uncertainty related to this company and how well they compare to Amazon and Alibaba over the years, and only time will tell whether they're able to generate a net income in a more consistent consistent way, and if you're able to see a net income margin over 2%. Based on a technical factor, I feel like it's a little bit too overextended and overbought because it has run up over 70% since March, which is a very short period of time for the stock to almost double in value. So I'm going to personally wait, and I have my alerts set up at $51. So if the stock does breach that level, I would personally be very interested in looking into it more. I hope you guys enjoyed this video, and if you did, please make sure to drop a like. It really helps out with the YouTube algorithm and recommends this video to other people who might be interested in watching. Also, subscribe and hit that notification bell so you don't miss out on any future market updates, stock breakdowns, and technical analysis. As always, happy investing, and I will see you guys in the next video.